You aren't buying a stock. You're not purchasing a ticker symbol that dances across a screen in patterns of red and green. You are not acquiring a fleeting digital receipt, a speculative chit to be flipped for a quick profit. What you are doing, whether you realize it or not, is becoming an owner. You are purchasing a fractional but very real piece of an ongoing business enterprise. A business with buildings, with employees, with customers, with products, with a reputation, with a future. This single shift in perspective, this evolution from speculator to proprietor, is the most profound and valuable secret in the world of finance. It is the genetic code of Warren Buffett's entire philosophy, the intellectual bedrock upon which the entire Berkshire Hathaway empire was built. It is the final promise of investing, that by thinking like an owner, you can finally achieve the results of an owner. Most people walk into the stock market as if it were a grand global casino. They hear whispers of hot tips. They see the frenetic energy of the trading floor. They feel the intoxicating rush of a quick gain and the sharp sting of a sudden loss. They are gamblers, placing bets on the short-term movements of prices they do not understand, attached to businesses they have not studied. But Warren Buffett does not see a casino. He sees a marketplace, a place where, every day, thousands of partial interests in American and global businesses are offered for sale. His job, as he sees it, is not to guess which number the roulette wheel will land on next. His job is to wander through this marketplace, inspecting the quality of the businesses on offer, calculating their true long-term worth, and, on the rare occasion he finds a wonderful business being offered at a silly price, to buy a piece of it, not for a day, not for a week, but to hold, as a partner, for the long term. This deconstruction of the business owner mindset is not just another piece of financial education, it is an invitation to leave the casino floor forever. It is a roadmap to transform your relationship with your own capital, to move from the frantic anxiety of speculation to the quiet confidence of ownership. We will dissect this mindset into its 5 core pillars, each one a load-bearing wall in the architecture of long-term wealth. We will journey through the specific anecdotes, the psychological principles, the practical models, the common failures, and the direct financial consequences of this powerful philosophy. This is not about learning to trade, this is about learning to own, and in that distinction lies the path to genuine, lasting financial freedom. The first pillar, the absolute foundation of this entire worldview, is the understanding that the business is the reality, and the stock is the illusion. The flickering quote on your screen is not the business. The breathless commentary on financial news is not the business. The fearful headlines and the euphoric predictions are not the business. The business is the collection of people, assets, and ideas that are working, right now, to sell a product or service to a customer. It is the tangible entity that generates earnings and cash flow. The stock is merely a claim on that reality, and its daily price is nothing more than the moody, often irrational opinion of the crowd about that reality. A true business owner learns to anchor themselves to the business, not the opinion. There is no story that illuminates this principle more powerfully than Warren Buffett's handling of the great salad oil scandal of 1963. It was a moment of sheer panic, a crisis that threatened to bring a blue-chip American institution to its knees. The company was American Express. At the time, one of its lesser-known but substantial business lines was warehousing. It would store goods for companies and issue warehouse receipts, which the companies could then use as collateral for loans. It was a business built entirely on trust. A small, seemingly insignificant company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation was a major customer. They stored vast quantities of salad oil in American Express's tanks. Then, the news broke. The president of Allied, a man named Tino DeAngelis, was a con artist of epic proportions. His tanks, supposedly brimming with millions of dollars worth of salad oil, were mostly filled with seawater, with just a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied collapsed, defaulting on over $175 million in loans that had been secured by worthless American Express warehouse receipts. The banks, holding these fraudulent receipts, turned to American Express and demanded to be made whole. The market went into a state of complete and utter terror. Wall Street believed American Express was on the hook for the entire sum, a liability that could potentially wipe out its entire net worth. The stock, which had been trading at over $60 a share, was bludgeoned. It collapsed by nearly 50%, plunging to $35. The narrative was simple and terrifying. American Express was finished. The stock, the flickering illusion, was screaming bankruptcy. But Warren Buffett, a young, little-known fund manager from Omaha, refused to listen to the screams of the illusion. He decided to investigate the reality. He didn't call other traders. He didn't read panicked analyst reports. He acted like a business owner trying to understand his own company. What was the real, underlying business of American Express? It wasn't primarily warehousing, it was travelers' checks and the American Express charge card. So Buffett began his due diligence. He went to restaurants in Omaha. He sat with cashiers and managers and asked them, "Has this scandal changed anything? Are people still using the card?" He talked to bank tellers, asking if they were still selling travelers' checks. He even sent people to travel agencies. The answer he got back was unanimous and overwhelming. The real business was not only unharmed, it was completely unaffected. Customers didn't associate the American Express brand, the trusted name on their green card, with a rogue salad oil warehouse in New Jersey. The competitive moat around the card and traveler's check business was as wide and deep as ever. He realized the market was confusing a single, damaged branch of the business with the entire, healthy tree. He did the math and calculated that even if American Express was forced to pay every single fraudulent claim, the hit to its long-term earning power would be significant, but nowhere near fatal. The core business was a money-gushing machine that would quickly replenish the losses. The market saw a worthless stock, quote, at $35. Buffett saw a world-class financial franchise, the reality, being offered for sale at a ludicrously cheap price. While Wall Street was dumping the stock in a panic, Buffett was quietly and aggressively buying. He invested a staggering 40% of his partnership's capital, $13 million, into American Express stock. It was the single largest investment of his career up to that point. Within a few years, as the company settled the claims for a fraction of what was feared and the core business continued to grow exponentially, the stock price soared. The illusion of the stock price eventually had to catch up with the reality of the business's success. Buffett's investment turned into a massive multi-bagger, a foundational fortune that helped build Berkshire Hathaway. He did it by completely ignoring the manic-depressive noise of the market and focusing with unshakable discipline on the simple, underlying truth of the business itself. The psychological force that Buffett harnessed in the salad oil scandal is a concept his mentor, Benjamin Graham, personified in the allegory of Mr. Market. This is perhaps the single most important mental model for any long-term investor. Graham asks you to imagine that you are partners in a private business with a man named Mr. Market. Every day, without fail, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his, at a specific price. The critical thing to understand about your partner is that he is a manic depressive. Some days, he is euphoric. He sees nothing but a rosy future for the business and quotes you a ridiculously high price. On other days, he is inconsolably pessimistic. He sees nothing but trouble ahead and offers to sell you his share for a pittance. The key is this: Mr. Market is there to serve you, not to guide you. You are free to ignore him completely. You would be a fool to let his daily mood swings influence your own assessment of the business's true worth. If he shows up screaming in terror and offers you a price far below what you know the business is worth, you should take advantage of his foolishness and buy his shares. If he shows up giddy with irrational optimism and offers you a price far above its real value, you might consider selling him your shares. If his price is somewhere in the middle, you simply ignore him and get on with your day, confident in your ownership of a good business. This allegory is a profound psychological tool because it directly combats two powerful cognitive biases. The first is herd behavior, the instinct to do what everyone else is doing. When the stock price of American Express was collapsing, the herd was selling. It takes immense fortitude to stand apart and buy. By personifying the market as a single, unreliable individual, you depersonalize the herd. You're not fighting against the wisdom of the crowd. You're simply ignoring the ravings of your crazy partner. The second bias it addresses is cognitive dissonance. This is the mental discomfort we feel when our beliefs conflict with new information. If you believe American Express is a great business but the stock price is plummeting, you experience intense dissonance. The easiest way to resolve this discomfort is to change your belief. Maybe I was wrong. The market must know something I don't. I should sell. The Mr. Market allegory provides an anchor. It allows you to hold two opposing ideas in your mind. My business is valuable, and the market is currently pricing it foolishly. This framework prevents the stock price, the illusion, from overriding your own rational assessment of the business, the reality. Buffett wasn't a genius for seeing that American Express was a good business. His genius was in having a psychological framework that allowed him to act on that knowledge when a crazy Mr. Market offered him a bargain. So how do we, as individual investors, translate this powerful concept into a practical, repeatable process? The blueprint is a mental model I call the private buyer test. Before you ever purchase a single share of a public company, you must force yourself to run this simulation. It's a simple but profound exercise that instantly shifts your perspective from that of a stock picker to that of a business owner. First, you ignore the per-share price. That number is an arbitrary distraction. Instead, you look up the company's total market capitalization. This is the true price tag. It's the share price multiplied by the number of shares outstanding. This is what it would cost to buy the entire company, lock, stock, and barrel. Let's say a company's stock is trading at $50 per share, and it has 100 million shares outstanding. The per-share price is $50. But the price of the business is $5 billion. Now, step 2 is to imagine that this company is not a faceless corporation on the New York Stock Exchange. Imagine it is a private local business in your town, the best plumbing company, the most popular restaurant, the most efficient factory, and it is for sale. The owner wants $5 billion for it. Step 3 is the critical question. Based on your analysis of this business, would you, if you had the $5 billion, write a check and buy the entire enterprise at that price? To answer this, you are forced to stop thinking about charts and start thinking like a proprietor. You have to ask the real questions. How much profit does this plumbing company actually make in a year? Are its customers loyal? Is it facing new competition? Is the owner, the CEO, trustworthy and competent? Is the price of $5 billion a fair deal, a good deal, or a ridiculously expensive deal given its annual earnings? This test shatters the abstraction of the stock market. Buying a $100 share of a company feels trivial, but asking if you would pay $50 billion for the whole company forces a level of seriousness and due diligence that is otherwise absent. If you look at a business and say, there is no way on earth I would pay $5 billion for this entire company, it's not worth half that, then you have absolutely no business buying a single $50 share. The private buyer test acts as a powerful filter. It forces you to connect the price you are paying to the underlying reality of the business you are acquiring. It automatically makes you a value investor because you are no longer just buying a popular stock. You are seeking to purchase a claim on future earnings at a reasonable price. This single mental model, applied with discipline, will prevent you from ever again getting swept up in speculative manias and buying businesses at prices no rational private owner would ever consider. The opposite path, the path taken by 99% of market participants, is what we can call ticker tape hypnosis. This is the state of being mesmerized by the dance of the stock ticker, believing that the price movements themselves contain all the relevant information. The person in this state of hypnosis sees the stock, not the business. Their decisions are driven by greed and fear, triggered by the colors on their screen. They buy a stock because it's going up, a decision fueled by the fear of missing out. They sell a stock because it's going down, a decision fueled by the fear of further loss. They have absolutely no anchor to the underlying value of the enterprise. Consider the dot-com bubble of the late 1990s. Companies with no revenue, no profits, and often no viable business plan were coming to the market and seeing their stock prices double, triple, or quadruple in a single day. People were quitting their jobs to become day traders. Were they conducting a private buyer test? Were they asking if this pet food delivery website, which loses $100 million a year, were a private business for sale in my town for $10 billion, would I buy it? Of course not. The question is absurd on its face. They were hypnotized by the ticker, the price was going up, and that was the only piece of information they cared about. They confused the illusion with the reality. And when the illusion shattered, when the market realized these were not sustainable businesses, trillions of dollars of wealth were wiped out. People who had bought Pets.com at its peak lost everything, not because they had invested in a bad business, but because they hadn't invested in a business at all. They had placed a bet on a rising number on a screen. The business owner mindset is the permanent cure for this hypnosis. It forces you to look through the ticker tape to the factory or the storefront behind it. The direct financial connection between this mindset and your net worth is profound and twofold. First, it allows you to capitalize on fear. Markets are emotional. They swing from greed to fear like a pendulum. During times of panic, like the salad oil scandal of 1963 or the financial crisis of 2008, the prices of excellent businesses become detached from their underlying reality. Mr. Market is offering to sell you his share of a wonderful enterprise for a fraction of its true worth. The person suffering from ticker tape hypnosis sees the falling price and sells in a panic, crystallizing their losses. The business owner, anchored to their own assessment of the company's value, sees the same falling price as a once-in-a-decade buying opportunity. This single behavior, buying when others are fearful, is responsible for more generational wealth creation than any other investment strategy. Second, it protects you from bubbles and permanent capital loss. By applying the private buyer test, you create a valuation ceiling for yourself. You will simply be unable to participate in the most egregious manias. When a stock's market capitalization soars to a level that no rational private buyer would ever pay for the whole business, you are automatically sidelined. This doesn't mean you'll catch every market top, but it will absolutely prevent you from buying a $10 billion company with no earnings. It protects you from the catastrophic blow-ups, from which portfolios can never recover. In the long run, avoiding the big mistakes is even more important than picking the big winners. The foundation of the business owner mindset, seeing the business, not the stock, is therefore the ultimate tool for both risk management and opportunistic wealth creation. It is the first and most important step toward true stock ownership. The second pillar of the business owner mindset is the unwavering mandate of due diligence. This is the natural and necessary consequence of the first pillar. If you truly accept that you are buying a piece of a business, then you must accept the responsibility to investigate that business with the same rigor you would if you were buying it in its entirety. You are not buying a lottery ticket based on a hunch or a hot tip. You are making a significant capital allocation decision. You are becoming a silent partner in an enterprise, and you owe it to your own financial future to understand exactly what you are buying. This means rolling up your sleeves and doing the work of fundamental analysis. The story that best exemplifies this commitment to deep understanding is Buffett and Munger's purchase of See's Candies in 1972. This was a pivotal moment for Berkshire Hathaway. Up to that point, Buffett had primarily been a practitioner of cigar butt investing, finding struggling, statistically cheap companies that had one last puff of value left in them. See's Candies was different. It was not a struggling company. It was a jewel. It was a beloved, family-owned chocolate company based in California, with a fanatically loyal customer base. The Blumkin family, who owned it, wanted to sell for $30 million. Buffett and his partner, Rick Guerin, did the initial analysis and calculated that the tangible assets of the company, the buildings, the equipment, the inventory, were only worth about $8 million. Their initial offer was $25 million, which the family rejected. Buffett was ready to walk away. Buying a business for more than 3 times its tangible book value was a radical departure from his deep-rooted Grahamite principles. It was Charlie Munger who changed his mind, and in doing so, changed the course of Berkshire Hathaway forever. Munger forced Buffett to look beyond the simple numbers on the balance sheet and to perform a deeper form of due diligence on the qualitative aspects of the business. They began to analyze See's not as a collection of assets, but as an economic franchise. They saw that See's had immense pricing power. Customers were so loyal to the brand, and the chocolate was so often bought as a gift for special occasions like Valentine's Day or Christmas, that the company could raise its prices year after year without losing business. This brand loyalty was an intangible asset, but it was more valuable than any factory or truck. They realized that the company gushed cash. It didn't require huge amounts of capital investment to grow. Customers effectively financed its inventory by paying in cash. They did the work. They studied the culture, the brand, the customer behavior. They understood that what they were buying for $30 million was not just $8 million in assets, but an economic castle with a deep, wide moat around it, a moat built of customer affection and tradition. Munger famously told Buffett, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." They went back and paid the family's asking price of $30 million. Over the subsequent decades, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was an astronomical success. And it was born not from a spreadsheet, but from the deep, qualitative due diligence of a true business owner who sought to understand the very soul of the company he was buying. The psychological trap that this level of due diligence helps an investor avoid is known as the Dunning-Kruger effect. This is a cognitive bias where people with low ability at a task overestimate their ability. In investing, it manifests as the novice who, after 1 or 2 lucky trades, believes they have mastered the market. They become overconfident and start making bets in areas they know nothing about. The business owner's mandate for deep research is the perfect antidote to this. It forces intellectual humility. It forces you to confront what you don't know. This leads directly to one of Buffett's most critical concepts, the circle of competence. Imagine a circle. Inside the circle are all the businesses and industries that you, through your own experience, study, or professional background, understand deeply. You know how they make money, what their competitive landscape looks like, and what the key drivers of their success are. Outside the circle is everything else: biotechnology, complex financial derivatives, obscure software sectors. The rule is simple, but inviolable. You must only ever invest inside your circle of competence. It doesn't matter how large your circle is. What matters is that you know precisely where the perimeter lies. As Buffett says, you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. The mandate of due diligence is the process by which you define and operate within this circle. When you force yourself to answer the hard questions about a business, you quickly discover whether you are inside or outside your circle. If you can't explain in simple terms how a company makes money and why it will still be making money in 10 years, you are outside your circle, and you must not invest, no matter how exciting the story sounds. This is a psychological safeguard of immense power. It protects your ego from leading your portfolio into ruin. It replaces the arrogant overconfidence of the Dunning-Kruger peak with the humble and far more profitable wisdom of knowing what you don't know. To make this actionable, we can translate Buffett's investment philosophy into a practical blueprint, the 4 filters checklist. This is the mental model for conducting owner-like due diligence. Before you buy any stock, you must be able to give a clear and confident yes to each of these 4 questions. Filter 1. Is the business simple and understandable to me? This is the circle of competence test. You must be able to describe the business model on the back of a napkin. If it involves complex technology or an opaque business process that you don't grasp, the answer is no. Sub-questions include: how does it generate revenue? Who are its customers? What is its core product or service? Could I explain this to a 10-year-old? Filter 2. Does the business have a durable competitive advantage? Buffett calls this a moat. A moat is a structural feature that protects the company from competitors, allowing it to earn high returns on capital for a long period of time. This is the See's Candies insight. Sub-questions for identifying a moat include: does it have a strong brand that commands pricing power, like See's or Coca-Cola? Does it have a network effect, where the product becomes more valuable as more people use it, like American Express or Facebook? Is it the low-cost producer in its industry, like Costco or Geico? Does it have high switching costs that make it difficult for customers to leave, like a bank or a software provider? Does it have a unique patent or regulatory advantage? Filter 3. Does the company have able and trustworthy management? You are becoming a partner with these people. You need to know if they are honest and skilled. This is the Mrs. B test from Nebraska Furniture Mart. Sub-questions include: how do they talk to shareholders in the annual report? Are they candid about mistakes? How do they allocate capital? Do they reinvest in the business wisely, buy back shares at good prices? Or do they waste money on foolish, ego-driven acquisitions? Is their compensation reasonable and tied to long-term performance? Do they own a lot of the company's stock themselves, aligning their interests with yours? Filter 4. Is the stock available at an attractive price? This means a price that provides a margin of safety, a concept we will explore in a later pillar. It's not enough to find a great business with great management. You must buy it at a price that makes sense. The question here is: does the current market capitalization represent a significant discount to a conservative estimate of the company's long-term intrinsic value? By rigorously applying this 4-filter checklist to every potential investment, you transform yourself from a speculator into a disciplined capital allocator. You are no longer chasing tips. You are executing a proven, repeatable process for identifying high-quality businesses to own for the long term. This is the essence of professional investment due diligence. The path of the 99% stands in stark contrast to this disciplined process. It typically falls into one of 2 failure modes: impulsive gambling or analysis paralysis. The impulsive gambler is far more common. This is the individual who hears a stock tip from a friend, sees a talking head on TV recommend a company, or reads a single exciting headline. They experience a jolt of FOMO, fear of missing out, and immediately buy the stock with little to no research. They haven't checked the valuation, they don't understand the business model, they know nothing about the management. They are buying a story, a lottery ticket. This behavior reached its zenith during the dot-com boom, where people were buying shares in companies named things like eToys.com or Webvan, simply because they had .com in their name. The result was a predictable and catastrophic loss of capital for millions of people who substituted a 5-minute emotional decision for the hours of rational due diligence that true ownership requires. The other, less common but equally ineffective path is analysis paralysis. This is the person who understands the need for research but gets lost in the weeds. They build spreadsheets with hundreds of variables, read every arcane financial filing, and get so bogged down in gathering data that they can never synthesize it into a clear decision. They are so afraid of making a mistake that they never make a move at all, and their capital sits on the sidelines, earning nothing. The 4 filters checklist is the antidote to both conditions. It is simple enough to prevent paralysis, forcing you to focus only on the handful of variables that truly matter. but it is rigorous enough to prevent gambling, demanding that you answer the most fundamental questions of business ownership before you commit a single dollar. The direct financial connection between rigorous due diligence and your portfolio's performance is about minimizing risk and maximizing the quality of your returns. The most important financial outcome of this process is the avoidance of permanent capital loss. By filtering for understandable businesses with durable moats and honest management, you dramatically reduce the probability of investing in a company that goes to zero. A speculative, unresearched portfolio is fragile. It is full of landmines. A well-researched, owner-like portfolio is robust. It is built to withstand economic shocks and competitive threats. Furthermore, this process directly connects to the quality of a company's financial statements. A business with a deep, durable moat, the kind you identify and filter to, is a business that can consistently generate high returns on invested capital. This isn't an abstract concept. It's a number you can find and track. It means for every dollar the company reinvests in itself, it generates a high rate of return. This high return on capital is the engine of long-term value creation. It translates directly into growing earnings, growing free cash flow, and ultimately a growing intrinsic value for your share of the business. A company without a moat may have 1 or 2 good years, but it will eventually be competed away by rivals, its profits will shrink, and its stock will languish. Due diligence is the process of separating the temporary winners from the permanent, compounding machines. It is the only way to ensure that the businesses you own are capable of generating the kind of financial results that build real, generational wealth. This leads us to the third pillar, a direct consequence of treating your stocks like businesses, the adoption of an indefinite holding period. If you have done the hard work of finding a wonderful, understandable business with a deep moat and honest management, and you've bought it at a fair price, why would you ever want to sell it? A true business owner doesn't buy a thriving local enterprise with the intention of flipping it in 6 months. They buy it to enjoy its profits for years, even decades. This shift in time horizon, from thinking in days to thinking in decades, is one of the most powerful and counterintuitive secrets to investment success. It is the mechanism that allows the magic of compounding to do its work. The story that perfectly captures this long-term owner's mindset is Buffett's 1973 investment in the Washington Post Company. At the time, the stock market was in a deep funk. The Nifty 50 bubble had just popped, and high-quality growth stocks had been decimated. The Washington Post, a premier media franchise, saw its stock fall from around $38 to just $6 per share. The market was pricing it as if it were on the verge of collapse. Wall Street was panicked about the competition from television and the health of the newspaper industry. The illusion of the stock price was screaming, "Sell." Buffett, applying his business owner lens, saw a completely different reality. He saw an institution with an almost monopolistic grip on its market. It was the dominant newspaper in the nation's capital, an essential read for anyone in government and politics. This gave it immense pricing power with its advertisers. He saw a brand with unimpeachable integrity, led by a family, the Grahams, and an editor, Ben Bradley, who were committed to quality journalism. He saw a business that, despite the market's fears, was gushing cash. He conducted his due diligence and concluded that the entire company was being valued by the market at around $80 million. Buffett thought to himself that he could sell off its individual television stations and other assets for $400 million and still have the newspaper for free. The business was worth at least 5 times what the stock market was saying it was worth. So he started buying, and he didn't stop until Berkshire Hathaway had invested nearly $11 million, becoming the company's largest outside shareholder. He didn't buy it because he thought the stock would pop next quarter. He bought it because he believed that for the next 10, 20, or 30 years, the Washington Post was going to be an extraordinarily profitable enterprise. He joined the board of directors and held the stock as a core position for over 4 decades. That initial $11 million investment grew to be worth over $1 billion, a return of more than 100 times his original capital. It was a staggering success, achieved not by clever timing or frantic trading, but by the simple act of buying a piece of a wonderful business at a silly price, and then having the patience and conviction to hold on, like a true owner, for the long run. The psychological demons that this long-term perspective slays are powerful and pervasive. The first is called hyperbolic discounting. This is a cognitive bias, where our brains are wired to disproportionately value immediate rewards over larger delayed rewards. Given the choice between $10 today or $15 in a month, many people will impulsively take the $10 now. This is the bias that makes the thrill of a quick day trading profit feel more satisfying than the slow, patient process of long-term compounding. The indefinite holding period mindset is a conscious and deliberate override of this flawed mental wiring. It trains your brain to focus on the much larger reward that comes from letting a great business grow and compound its value over decades. The second related bias is myopic loss aversion. Myopic means short-sighted. Loss aversion is the well-documented psychological principle that the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. Myopic loss aversion is the tendency to feel this pain of loss over very short time horizons. If you check your portfolio every day, you will inevitably see it go down. Each time it does, you feel a sharp sting of pain, far greater than the pleasure you feel on the up days. This constant exposure to short-term volatility and the pain of small losses is what causes people to panic and sell at the absolute worst time, usually during a market crash. By adopting a multi-decade time horizon, you mentally zoom out. You stop looking at the daily, meaningless squiggles of the stock chart. You understand that over your holding period of 20 years, there will be recessions, crashes, and panics, but that these are just short-term noise in the long-term upward trend of the great business you own. This perspective insulates you from the emotional roller coaster that destroys most investors. A powerful applied mental model to cultivate this long-term patience is what Buffett calls the farm ownership analogy. He asks you to imagine that you have invested your family's entire net worth into a highly productive farm. A few years later, your neighbor, a very moody and opinionated fellow, comes over every single day and shouts a price at which he'd be willing to buy your farm. Some days the price is high, some days it's low. Now how would you react? Would you sell the farm your family depends on just because your neighbor was in a bad mood one day and offered you a low price? Of course not. Would you rush to buy his farm just because he was feeling euphoric and offered it at a high price? No. You would ignore him. Your focus would be on the farm itself. You would ask yourself, how is the farm performing as a business? You would measure its output, the bushels of corn or soybeans it produces each year. You would think about how to increase its long-term productivity by investing in better irrigation or equipment. You would concern yourself with the harvest, the real cash profits the farm generates. You wouldn't dream of selling a wonderful, productive asset based on the daily mood swings of your neighbor. Now simply substitute farm with business and daily price quote with stock market. When you own a share of Coca-Cola, you own a small piece of a global farm that produces a cash harvest every year. Why would you sell your piece of that productive farm just because Mr. Market is feeling pessimistic one afternoon? This mental model completely reframes your relationship with your portfolio. You stop being a stock picker and start being a farm owner. Your goal is no longer to guess the daily price changes, but to acquire pieces of the most productive farms you can find and hold them for a very, very long time, collecting the harvest of their earnings along the way. The opposite of this patient, owner-like approach is the churn and burn portfolio. This is the fate of the vast majority of retail investors. They are constantly in motion, buying the latest hot stock, selling last year's winner, trying to time market tops and bottoms. Their portfolio has a high turnover rate. They are not owners, they are renters of stocks. This strategy is not just philosophically flawed, it is financially ruinous for two very concrete reasons: transaction costs and taxes. Every time you buy or sell a stock, you may incur a small commission or fee. While these may seem insignificant on a single trade, over a lifetime of constant churning, they add up to a substantial drag on your returns. But the far greater enemy is taxes. In the United States, if you sell an investment that you've held for less than a year, the profit is considered a short-term capital gain and is taxed at your ordinary income tax rate, which can be as high as 37% or more. If you hold an investment for more than a year, it's considered a long-term capital gain and is taxed at a much more favorable rate, typically 15 or 20%. The churn-and-burn investor is constantly realizing short-term gains and handing over a huge chunk of their profits to the government each year. The indefinite hold investor, the farm owner, defers these taxes for years or even decades. The direct financial connection here is the unimpeded power of tax-deferred compounding. Let's run a simple, powerful example. Imagine two investors, both starting with $100,000. Both managed to earn a respectable 12% annual return on their investments. Investor A is a farm owner. She buys a portfolio of great businesses and doesn't sell for 30 years. Her money compounds at 12% per year, untouched by taxes. Investor B is a churn-and-burn trader. He also earns 12% per year, but he realizes all of his gains each year and pays a 30% short-term capital gains tax on his profits. After 30 years, Investor A, the owner, would see her initial $100,000 grow to nearly $3 million. She would only pay capital gains tax once, at the very end, on her total profit. Investor B, the trader, would have a dramatically different result. Each year, his 12% gain is reduced to an 8.4% gain after taxes. After 30 years of this tax-handicapped compounding, his initial $100,000 would have grown to only about $1.1 million. The difference is staggering. Nearly $2 million. That is the price of impatience. That is the cost of being a trader instead of an owner. The indefinite holding period is not just a quaint philosophy. It is a mathematical imperative for anyone serious about achieving financial freedom. It is the only way to let the unstoppable force of compounding work for you rather than for the taxman. The fourth pillar of the business owner mindset flows logically from the first three. If you are buying a business, not a stock, if you have done your due diligence, and if you intend to hold it for decades, then you must be intensely focused on the quality and integrity of the people who are running the business day to day. You are not just buying assets. You are entering into a long-term partnership with the company's management team. Your financial success is directly in their hands. Therefore, you must evaluate them not as celebrity CEOs or slick presenters, but as the partners you are entrusting with your capital. There is no story that better illustrates Buffett's focus on management as partners than his 1983 acquisition of Nebraska Furniture Mart. The company was a retailing phenomenon in Omaha, founded by a tiny, indomitable Russian immigrant named Rose Blumkin, known to everyone as Mrs. B. She had started the business in a basement with a $500 loan and built it into the largest and most profitable home furnishing store in the country, doing over $100 million a year in sales. Her business philosophy was brutally simple: sell cheap and tell the truth. She was a famously tough negotiator and a brilliant, intuitive merchant. Buffett had admired her from afar for years. One day he went to see her and, after a brief conversation, offered to buy 90% of the business. Mrs. B, then 89 years old, thought about it for a moment and said yes. The price was $60 million. What happened next is the stuff of legend. Buffett bought the company with a simple handshake and a 2-page contract that he wrote himself. He conducted no audit. He didn't send in teams of accountants to verify the inventory or the receivables. He asked Mrs. B how much cash the business had, how much it owed, and what she thought it was worth. He took her at her word. Why? Because his due diligence wasn't on the numbers, it was on the person. He knew, from decades of observation, that Mrs. B was scrupulously honest and a business genius. He was not buying a collection of furniture. He was partnering with Rose Blumkin. He knew that with her and her family continuing to run the business with their owner-like intensity, his investment was perfectly safe. He was right. Nebraska Furniture Mart has since become a multi-billion-dollar enterprise and a core part of Berkshire Hathaway, a testament to the power of betting on the right partners. The psychological danger that this focus on management helps to overcome is known as the principal-agent problem. In business theory, the owners of a company are the principals, and the managers they hire to run it are the agents. The problem is that the interests of the agents are not always aligned with the interests of the principals. A CEO, the agent, might be more interested in maximizing their own salary, getting a bigger corporate jet, or building a larger empire through reckless acquisitions than they are in maximizing the long-term per-share value for the owners, the principals. This is one of the most persistent and destructive forces in corporate America. Buffett's entire approach to evaluating management is designed to solve the principal-agent problem. He is looking for managers who don't act like agents. He is looking for managers who think and act like principals, like owners themselves. He wants to see CEOs who are obsessed with the business, not their own compensation. He wants leaders who treat shareholder money as if it were their own. This also helps to counteract the powerful effect of social proof. Many investors are swayed by a charismatic CEO who is popular in the media or gives a great presentation on an earnings call. They trust the leader because everyone else seems to trust them. Buffett's analysis cuts through this superficial charm. He ignores the charisma and looks for evidence of two key traits: integrity and rational capital allocation. He reads their past annual reports, their letters to shareholders, to see if they are candid and honest. And he studies their track record of capital decisions, which he believes is a CEO's most important job. To apply this principle, investors can use a mental model called the CEO report card. This is a practical framework for grading management not on their personality, but on their performance as stewards of your capital. It focuses on three key areas. First, capital allocation skill. This is the most critical grade. How does the management team use the company's excess cash? There are 5 possibilities: reinvest it back into the business, acquire other businesses, pay a dividend, pay down debt, or buy back its own stock. A great manager will only reinvest capital in projects that promise a high rate of return. They will only make acquisitions at sensible prices that add real value. They will buy back stock only when it is trading below its intrinsic value, thereby making the remaining shares more valuable. A poor manager will do the opposite. They will engage in, quote, diversification, buying unrelated businesses they don't understand, or they will repurchase stock at record high prices to artificially boost earnings per share. You must study their history of these decisions to grade their skill. Second, candor and transparency. Grade them on how they communicate with you, the owner. Read their annual letter to shareholders. Do they speak in plain English, or do they hide behind jargon and corporate doublespeak? Do they openly admit to mistakes they have made in the past, or do they only talk about their successes? As Buffett says, what is smart in the investor is wise in the business manager. We look for managers who are candid in reporting to you, emphasizing the pluses and the minuses in equal measure. A CEO who is not honest in their communication is unlikely to be an honest partner with your money. Third, shareholder alignment. You need to assess if their financial interests are aligned with yours. Grade them on their compensation structure. Is their bonus tied to metrics that actually create long-term value, like return on invested capital? Or is it tied to short-term, easily manipulated metrics like quarterly earnings? And most importantly, do they eat their own cooking? Does the CEO and the board of directors own a significant amount of the company's stock, purchased with their own money? When management has a large portion of their own net worth in the same boat as you, the principal-agent problem tends to melt away very quickly. The antithesis of this careful evaluation is the cult of the visionary CEO. This is the common mistake of falling in love with a charismatic, media-savvy leader without ever scrutinizing their actual record. These are often empire builders, CEOs who are obsessed with growth for its own sake. They appear on the cover of magazines, and are celebrated as geniuses. They pursue massive, headline-grabbing mergers and acquisitions, often paying huge premiums and taking on enormous debt. Their goal is not to create per-share value for the owners, but to build the biggest company in their industry, to satisfy their own ego. History is littered with examples of these celebrity CEOs who were lauded by the market right up until the moment their empires collapsed under the weight of their poor capital allocation decisions. Investors who joined the cult and bought the stock based on the CEO's charisma, rather than grading their actual performance, were left holding the bag. The CEO report card is the necessary, rational antidote to the emotional pull of the visionary CEO. It forces you to be a skeptical business analyst, not a fawning fan. The direct financial connection here is one of the most powerful in all of investing. The skill of management, particularly in capital allocation, is directly visible on a company's financial statements through a metric called Return on Invested Capital, or ROIC. This number measures how much profit the company generates for every dollar of capital that has been invested in the business. A company with a high and sustainable ROIC is a value-creating machine. A company with a low or declining ROIC is destroying value. The primary job of a CEO is to maintain or increase that ROIC. A manager who makes a brilliant acquisition or invests in a high-return project will increase the company's ROIC. A manager who overpays for a foolish acquisition will dilute it. Furthermore, a manager who is skilled at buying back shares when they are cheap can create enormous value for the remaining shareholders. If a business is worth $100 per share and the CEO uses company cash to buy back shares at $80, the intrinsic value of every remaining share just went up. Conversely, a CEO who issues new shares when the stock is cheap is diluting your ownership and destroying value. These are not abstract concepts. These are the executive decisions that directly determine whether your fractional ownership of the business becomes more or less valuable over time. By focusing on management as your partners and grading them accordingly, you are ensuring that the people at the helm are actively working to increase the long-term value of your investment, which is the ultimate driver of your financial returns. Finally, we arrive at the fifth and culminating pillar of the business owner mindset, the principle that ties everything together, understanding that price is what you pay, but value is what you get. A true owner knows that even the best business in the world can be a terrible investment if you overpay for it. Therefore, the final step in any investment decision is to insist on a, quote, margin of safety. This means you must purchase the business for a price that is significantly below your conservative estimate of its intrinsic value. This discount, this cushion, is your protection against bad luck, errors in judgment, and the inevitable uncertainties of the future. It is the ultimate expression of business-like investing. The quintessential story of the margin of safety in action is Buffett's landmark investment in Goldman Sachs during the peak of the 2008 financial crisis. It was September 2008. Lehman Brothers had just collapsed. The global financial system was on the brink of complete meltdown. Fear was absolute. The stocks of even the strongest financial institutions were being annihilated. Goldman Sachs, one of the most prestigious investment banks in the world, was facing a crisis of confidence. They needed capital, and they needed the ultimate seal of approval to calm the markets. They called the one person who could provide both, Warren Buffett. Buffett didn't try to guess the bottom of the market. He didn't make a panicked bet. He behaved like a disciplined business owner negotiating a purchase in a buyer's market. He analyzed Goldman Sachs not as a stock, but as a long-term business franchise. He knew its brand, its talent pool, and its long-term earning power were immense. He calculated what he thought the business was worth, and then structured a deal that gave him an enormous margin of safety. He didn't just buy common stock. He invested $5 billion in preferred stock that paid him a guaranteed 10% dividend, $500 million a year, no matter what the stock price did. On top of that, he received warrants that gave him the right to buy $5 billion worth of common stock at a fixed price anytime over the next 5 years. This deal structure was a masterpiece of owner-like thinking. The 10% dividend gave him a handsome return and downside protection. If the crisis got worse, he would still collect his $500 million a year. The warrants gave him massive upside potential. If, as he suspected, Goldman Sachs survived and thrived, the common stock would soar, and his warrants would be worth billions. He demanded a price and terms that no one else could get, because he was providing capital when no one else would. He bought a wonderful business at a time of maximum pessimism, and he insisted on a price that gave him a huge margin of safety. The investment was a home run. Berkshire Hathaway made billions on the deal, but more importantly, it was a perfect demonstration of the principle: calculate the value and then demand a discount. The psychological biases that the margin of safety principle conquers are loss aversion and anchoring. As we've discussed, the pain of loss is a powerful motivator, causing investors to sell at the bottom. The margin of safety acts as a psychological buffer. When you know you've bought a business for 60 cents on the dollar, the daily fluctuations in its price are far less terrifying. If the stock drops from 60 to 50, you're not panicked, because you're anchored to your knowledge that the underlying business is still worth $1. It gives you the emotional fortitude to hold on through volatility and even to buy more. The other bias it defeats is the anchoring bias. This is our tendency to rely too heavily on the first piece of information offered when making decisions. In investing, we often anchor to a recent high price. A stock falls from $100 to $50, and people think, wow, it's 50% off, it must be cheap. But the previous price of $100 is irrelevant. It might have been wildly overvalued at $100. It might still be overvalued at $50. The business owner ignores the anchor of past prices. They perform their own independent calculation of intrinsic value. If they calculate the business is worth $60 per share, then 50 is a bargain. If they calculate it's only worth 30, then 50 is a terrible price. The margin of safety forces you to create your own anchor based on business reality, rather than latching on to the market's arbitrary and emotional price history. To make this practical, we need an applied mental model, a simplified business valuation toolkit that any investor can use. We won't build a complex discounted cash flow model, but we can use 3 powerful Buffett-inspired heuristics to approximate intrinsic value and ensure we are getting a margin of safety. First, understand owner earnings. Don't just look at reported net income, which can be manipulated by accounting rules. Buffett defines owner earnings as a company's net income, plus depreciation and other non-cash charges, minus the average annual amount of capital expenditures the business needs to maintain its competitive position. This is a much truer measure of the cash that is actually available to the owners of the business each year. You can find these numbers on a company's financial statements. Second, apply the 10-year bond test. Once you have a handle on the company's owner earnings, calculate its earnings yield. This is simply the owner earnings per share divided by the current stock price. So, if a company earns $10 per share and the stock is trading at $100, its earnings yield is 10%. Now compare that yield to the yield on a long-term, essentially risk-free government bond. If the 10-year Treasury bond is yielding 3% and your business is yielding 10%, you are being compensated very well for the additional risk of owning a business. If the business is only yielding 4%, the risk might not be worth the reward. This provides a rational benchmark for what constitutes an attractive price. Third, calculate the payback period. This is a simple but powerful concept. Take the current market price of the stock and divide it by the company's current owner earnings per share. The result is the number of years it would take for the business's earnings to pay back your initial investment, assuming earnings don't grow. A company trading at $100 with $10 in earnings has a payback period of 10 years. A company trading at $500 with $10 in earnings has a payback period of 50 years. While this is an oversimplification, it provides a gut check. An owner thinks in these terms: how long until I get my money back from the business's operations? A short payback period generally indicates a more attractive price. Using this toolkit helps you move from guessing to estimating. which is the heart of disciplined, value-oriented investing. The opposite approach, the path of the 99%, is buying high and praying higher. This is the mindset of the momentum investor or the bubble participant. They have no concept of intrinsic value. Their only thesis is that a stock that has been going up will continue to go up. They buy because others are buying, a classic case of herd behavior. Their decision is based entirely on the stock's price action, the illusion, with zero regard for the underlying value of the business, the reality. This strategy works wonderfully, right up until the moment it doesn't. When the music stops and the price momentum reverses, these investors are left holding wildly overvalued assets, with no rational reason to continue owning them, and they are typically the first to panic and sell, locking in devastating losses. The Nifty 50 bubble in the early 1970s is a perfect example. Companies like Xerox, Polaroid, and Avon were considered one-decision stocks. Buy them at any price and never sell, because they were such high-quality growth companies. They were wonderful businesses, no doubt. But investors got so caught up in the story that they bid their prices up to astronomical valuations, sometimes over 50 or 60 times earnings. They completely abandoned the concept of a margin of safety. When the 1973-74 bear market hit, these stocks collapsed, falling 50, 70, even 90%. It took many of them over a decade just to get back to their previous highs. It was a brutal lesson. You can buy a wonderful business, but if you pay a terrible price, you can still lose a fortune. The margin of safety is the only principle that protects you from this fate. The direct financial connection of the margin of safety is the creation of asymmetrical returns. An investment with a large margin of safety is a bet that can be described as heads I win, tails I don't lose much. Let's quantify this. If you conduct a conservative valuation and determine a business is worth $100 per share, and you are able to buy it for $60, you have a $40 margin of safety. Your potential upside is at least 66% if the price reverts to its value. Your downside, however, is cushioned. The business is already selling for much less than it's worth, making a further permanent decline less likely. This principle directly impacts your portfolio's long-term performance and volatility. A portfolio constructed of businesses all bought with a significant margin of safety will not only have higher potential returns, but will also be far more resilient during market downturns. When a bear market hits, it is the overvalued speculative stocks that fall the hardest. The undervalued margin of safety stocks tend to fall less and recover faster because their prices were already anchored to a solid foundation of real business value. In the end, the margin of safety is not just a defensive tool, it is a powerful offensive weapon. It is the mechanism that allows you to make bold, concentrated investments during times of fear, just as Buffett did with American Express and Goldman Sachs, with the quiet confidence of an owner who knows they have tilted the odds overwhelmingly in their favor. It is the final, essential key to the business owner mindset. You have just invested a significant amount of your time and attention, and in doing so, you have acquired something of immense value. You have installed a new operating system for your financial mind, the complete five-pillar framework of the business owner mindset. You now understand how to separate the reality of a business from the illusion of its stock price. You have a mandate for rigorous due diligence and a practical checklist to guide you. You have grasped the profound mathematical and psychological power of an indefinite holding period. You know how to evaluate management as a long-term partner, not just a hired hand. And you have the ultimate tool for risk management and opportunistic buying, the margin of safety. This is not just a collection of tips, it is a coherent philosophy, a mental toolkit that can fundamentally and permanently change your financial trajectory. But it is crucial to understand that this powerful mindset does not operate in a vacuum. Warren Buffett's success comes from a network of interconnected mental models, an ecosystem of thought that works together. The business owner mindset is a foundational piece, the continent on the map of his mind. But there are other, equally critical territories to explore. Mastering this one piece gives you a tremendous advantage, but it also reveals a strategic knowledge gap. How does this mindset interact with the inescapable forces of inflation? How does one analyze the durability of a competitive moat in a world of rapid technological disruption? What specific accounting red flags does an owner look for that a speculator would miss? The answers to these questions are the missing links in the chain, the next pieces of the map that connect what you have just learned to an even higher level of mastery. The video that is now on your screen is not just another video. It is the next step in that logical progression. It is designed to bridge the gap between the philosophy of ownership and another core tenet of this mental arsenal. Think of what you have learned today as building the chassis of a world-class race car. The video before you now is the engine. The decision you make in the next few seconds is not about whether to watch another piece of content. It is a decision about your identity. Most people will stop here, satisfied with a surface-level understanding. They will have the blueprint but never build the house. But a small few, those who are truly committed to moving from the casino floor to the owner's box, those who are serious about their financial education and becoming true capital allocators, will see this as a critical and non-negotiable next step. The journey to completing your mental arsenal continues. The link that connects everything is right there. The choice to continue your ascent is yours.